Hi and welcome to Swissquote's Daily Market Talk. It's Monday, July 7th. OPEC announced a much bigger output hike this weekend than expected, while the clock is ticking louder for the US and partners to find a reasonable midway before the July 9th deadline to the 90-day tariff pause. So the week starts with some hope but mixed appetite across global financial markets as things could actually go both ways, really. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the week starts with renewed pressure on oil prices as OPEC decided to ramp up its production restoration plans by announcing to bring an additional amount of 548,000 barrels per day to the market, notably more than 411,000 barrels increase expected by analysts. So members also said that they will do the same in their September meeting. Hence, the 2.2 million barrel per day output restriction that was put in place back in 2023 will be completely restored a year earlier than planned and will remain a separate tranche of 1.6 million barrels per day capacity. That is additional voluntarily cuts by big members like Saudi Arabia and Russia before the supply cut strategy of OPEC Plus is totally unwound. And given that the cartel has shifted from the strategy of supporting oil prices to increasing their market share, there is no reason for them to hold on to this production restriction strategy any longer. Now, funny enough, OPEC apparently doesn't see the world through the same lenses than we do, because for them, the reason behind the faster oil restoration plan is a steady economic outlook and current healthy market fundamentals. But of course, we all know that the latter is not a given in the actual context of things, especially due to the heated global trade tensions across the globe, which led to some leading global organizations, including the OECD and World Bank, for example, to cut their growth forecast for this year and next. But whatever the reason behind the OPEC move, the additional barrels that will be coming to the market in the coming months will swell the oil supply prospects for the second half of this year and will inevitably weigh on oil prices. The knee-jerk reaction to OPEC's decision was relatively soft, though. A decision of this size could have actually easily sent the barrel of US crude below the $65 per barrel key support level this morning, which is the major 38.2% Fibonacci retracement level on year-to-date decline in oil prices, and which actually did act as a solid support to the latest geopolitical spike in oil prices. But to my surprise, while the barrel of US crude actually gap open lower near $66 per barrel level this morning, shortly stepped below this level, but has been recovering the early losses since then. Maybe on news that there is some renewed geopolitical tensions in the Middle East, and maybe on expectation that lower oil prices will pressure the US shale oil production, as the cost of producing shale oil ranges between $50 to $70 per barrel level depending on location, hence below the current oil prices, while the global oil output will not necessarily be increased but replaced. It will be replaced by producers who actually pump oil at much cheaper prices like Saudi Arabia, for example, and that will inevitably open the door for cheaper oil prices in the medium run. As such, the price rallies in oil are interesting opportunities to sell the tops, in my opinion. Solid resistance is seen into the $68-$70 per barrel range, which include the July resistance and the 200-day moving average, respectively. Unless fresh renewal of Middle East tensions, which is possible, well, we will likely see the bears slowly return to the market, especially the bears who have a gloomy outlook for the medium run. On the trade front, the weekend was certainly packed with trade negotiations as the July 9th deadline is approaching at a decent pace. within 2 days only. Trump administration will be announcing their tariff verdict to their trade partners. Apparently, Mr. Besson said that some countries among them will have 3-week extension to the deadline, but you can never really make sure that what is said now will be true in a minute from now. And you can't really be sure that the tariffs that will be announced in the next few hours or the next few days will remain the way that they are announced for more than a day. I mean, that is the reality of the field right now, and the latest news on the wire are not necessarily pointing at smooth ride. There was the BRICS meeting this weekend, for example, and while Donald Trump actually threatened to slap an additional 10% tariffs on countries that decide to align with them. So the trade drama is probably not ending this week, and that frustration will continue to keep visibility limited. As such, any disappointment and renewed quakes could easily dent investor appetite across the global equity markets, some of which trade near their all-time high levels without a fundamentally solid basis, mind you. Then the announcement of trade deals, on the other hand, could further fuel the rally that we have been seeing over the past few months. For a few more days probably before the earnings tell the real story behind the tariffs and their implication. And this story could actually be well gloomier than what the FOMO or the Tucker trade suggested in the second quarter of this year. Just saying, because the institutional traders have been very, very reluctant to come in, remember. Now, in the markets, Asian traders kicked off this week on a cautious note, understandably. Nikkei is under pressure below the 40,000 mark. The CSI 300 is offered under the 4,000 mark on the back of heating tensions between the European Union and China. US futures are in the negative this morning at the time I'm talking here, while the European futures look slightly better bid. While the S&P 500 closed a holiday shortened week last week at a fresh record high level, while the STOXX 600 index slipped below the 50-day moving average on Friday and tested the 100-day moving average to the downside on trade uncertainty. So let's see what kind of political meat Donald Trump will toss on the grill this week. We will either see a juicy jump or quite a bad slump. Now, in the FX markets, the US dollar is actually better bid against majors this morning despite the trade worries. Gold slips below its 50-day moving average despite uncertainties. The euro dollar consolidates gains just below the 118 psychological mark, while the dollar yen is testing the 145 resistance, with Japanese yen bears supported by the lower than expected wage income in May. The Aussie dollar, on the other hand, is certainly one of the most heavily hit major currencies this morning, just a day before the Reserve Bank of Australia is expected to announce another 25 basis point cut to give support to their economy amid global trade uncertainties and the weakening growth in China, while the Reserve Bank of New Zealand is expected to just remain seated on its hands when it meets this week. They are not expected to make any changes to their rate policy. Then the Federal Reserve minutes later this week may give some additional hints on how the Federal Reserve is not considering cutting the interest rates when jobs data remains so strong and inflation's trajectory is so uncertain, while the United Kingdom will be announcing a second straight month of GDP contraction later this week on Friday for the month of May, and that will follow last week's political drama at the heart of the UK's Labour Party that led to a short spike in long maturity gilt yields last week. And beyond the United Kingdom, it is also very much important to watch the long-term bond yields in Western and developed markets that have been rising quietly since the beginning of this month, and that could eventually be preparing the field for a broader risk-off move if news and data fail to keep investors happy this summer. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.